Hello, Anteaters. Good evening, good afternoon, or good morning, depending on where you are right now. Welcome to our latest UCI alumni event, Adulting for Anteaters, Stocks for Beginners. This is one of our quarterly virtual programs built specifically for UCI's young alumni. Tonight's stock topic has proven incredibly popular, with well over 1,100 registrants. First, I'd like to introduce myself. My name is Bryce Roberto, and I serve as Vice Chair of the Young Alumni Council. The Young Alumni Council, or YAC as we call it, is a think tank comprised of alumni who graduated in the last 10 years. YAC serves as a bridge between recent graduates and UC Irvine by promoting pathways for engagement to foster lifelong Anteater pride, working with the Alumni Association to create programming like the Adulting for Anteater series and the Anteater Network. The Anteater Network is a networking platform for students and alumni exclusively for Anteaters. Check it out at antnet.uci.edu. You can also visit the UCI alumni website for a ton of virtual resources so you can feel connected and engage with fellow alumni. Check out the upcoming events calendar, library of past programs, and more at alumni.uci.edu. We're in this together. Okay, so a bit of housekeeping. All attendees are muted in order to eliminate background noise and interference. However, we would love your participation via the Zoom Q&A function. Enter your questions for our speaker as we go along, and we will address them after the presentation. Feel free to also network in the chat. Now on to our speaker. Christopher Schwarz is an associate professor of finance at UC Irvine's Paul Merage School of Business, as well as faculty director for the Center for Investment and Wealth Management. During his time at UCI, he has been published in all leading academic and practitioner financial journals. His research has also been cited by the New York Times, LA Times, Wall Street Journal, and the Financial Times, and provided a number of economic forecasts in the community. Prior to arriving at UC Irvine, Christopher received his PhD from the University of Massachusetts Amherst, during which he was also a visiting doctoral fellow at Yale University's International Center of Finance. He received his Bachelor of Science from Babson College in Wellesley, Massachusetts. Let's give Christopher a big Anteater welcome.
Thank you so much, Bryce, for that introduction. And thank you all for coming here tonight and hearing go about saving and investing. And of course, excited to share some knowledge with you tonight. And of course, answer any questions that you might have. So I'm going to start here from the basics. I know that some of you may at this point, after 15 months of COVID, feel like you're on par with the best hedge funds in the world, but I know others of you are just getting started. So we'll start with the basics, then we'll talk a little bit about how you trade individual stocks, and then we'll go to the Q&A. So before we get started, just a couple caveats. All right, so a couple caveats that you'll probably agree or disagree with. So when I was a kid, and that's me as a kid. So my dad once told me, "Son, you can't make money if you don't have money." And so at that point, I think IBM or some other stock had crashed and he wanted to buy some. And at the time I probably used up all his money buying like whatever I was buying at the time. And so he's trying to impart on me that you need to save, right? You need to save as you get older. And so make sure you have a budget. So you can't invest if you don't have money, right? That's step number one. Make sure you have a budget. I think, budget is like dieting. Like it's really easy to make a budget. And it's really hard to stick to it. Like, I'm supposed to be on a diet right now and I'm getting ready for the webinar eating, Hershey Kisses. So obviously my diet's going well. So think about ways to stick to your budget. So if your problem is social media, so social media knows exactly what to show you to make sure that you want to buy stuff. Don't look at social media so much. One of the things I do is calculate how long it would take me to work to buy something. That usually gets me really turned off from buying it. Don't impulse buy. For example, if make an amount of money, and if you're walking around Target and you want to buy something that's over that amount of money, you have to wait till your next trip to Target to buy it. Chances are you'll never end up buying it. And there's lots of apps that can help you, track your budget, that can help you save. So obviously Mint has been around a long time. Pocket Guard is another one, and then Acorns, which is actually based right here in Irvine. What they do is help you to save by rounding up every transaction and putting it into an investment account, right? So you can't make money if you don't have you can't invest money if you don't save money. So make sure you save some money so you can invest. Caveat number two, gambling is not investing. All right. So we always think about, investing and gambling as not the same thing in finance. Maybe you think of it the same thing. If you want to go gamble, you can go with Zach Galifianakis and the rest of the Hangover crew to Vegas and play some blackjack. I'll be there playing some blackjack in a couple of weeks and some craps. That's gambling. All right. That is not investing. All right. Investing is, having some mutual funds, which we'll talk about a little later, or ETFs, or some other diversified portfolio. Having all of your eggs in one crazy basket is not investing. All right. So just to show you what I mean, this is GameStop. All right. So this is the average change on $1 million, right, is 134,000. So every day you wake up, right, the stock market may be open by the time you wake up, you have made or lost $134,000 this year in GameStop, right? That is not investing. That is gambling. Just to show you how ridiculous this is, if you owned the S&P 500, which is a broad stock market index, which people already think is risky, if I keep the scale on the y-axis exactly the same, this is what those returns look like. This is not a very risk-free investment. And you can see just how crazy the difference is between the S&P 500, a diversified portfolio, in terms of daily return risk, and GameStop. All right, so GameStop is not an investment. It is a gamble. In fact, who knew that GameStop, the most popular game that they had ever produced, is their stock? Go figure. Maybe everyone, they should just sell it at the stores and maybe they become more profitable. Caveat number 3, I'm going to say it. We're going to talk more about this later. Most SPACs, Bitcoin, Dogecoin, Tesla, GameStop, AMC, Beyond Meat, I'm going to say, I know you don't want me to, Michael Scott wouldn't want me to say it. They're probably not good long-term investments. All right. Either they're too expensive, they're too risky, they're not going to make it. And so we'll talk a little bit about those later. In fact, when we talk about stocks, if you want to trade, that's great. I'm going to spend most of the time telling you about how you're going to screw up and lose all your money eventually. All right. Eventually. All right. So why is investing important? I think everyone on the call here knows investing is important. That's why you're here tonight. You wouldn't be here tonight if you didn't think it was important. And the reason is because everybody's going to want to retire someday. Whenever I teach financial literacy to freshmen here on campus, I ask how many people want to retire, and all the students raise their hand. I ask how many people would you like to retire now, and almost all the students still have their hand up. And so you need to invest if you want to retire. You might want to invest because you want to spend more than you make every year, right? So if you look at a lot of celebrities, it's not like they're working hard for their money. They just have a lot of money and they are able to spend it. So maybe you want to spend more money than you earn each year. And of course, you want to do that responsibly. And if you want to do those things, then investing is going to be your friend, right? That's going to be the way that you're going to retire. That's the way that you're going to figure out how to spend more money than you make. All right, so just to show you why, just saving isn't good enough. All right, let's say imagine you start working at 22, and I know many of you are young alum, so you've been only working for a few years, and you want to retire at 67. So by the way, that's probably one of the more depressing things I tell freshmen. It's only 50 years until they get to retire probably. And those 45 years, let's say you're a really good saver. All right, let's say you could save 10% of your money. So here in the US, the average savings rate before COVID was only about 3 or 4%. All right, so this is double the savings rate. That's 10% of 45 years is only 4.5 years of income. So if you want to live past 71 and a half, then you're going to need to invest if you want to retire, right? So investing is basically required if you want to retire one day, right? You're going to have to invest, right? You're going to have to invest. All right, and sadly here in the US, we expect you to know a lot about investing. And so a lot of what I'm going to talk about tonight is the basics of investing, so you understand what you're doing. All right, so now you know you need to invest. When should you get started? All right, if you haven't got started investing, if you haven't started saving for retirement, today is the best day to start. All right, so there's some expression that says yesterday was the best day to start, but today is the second best day. Of course, if you're a procrastinator, then why do something today that you can always do tomorrow? But really, you should start investing today, because the sooner you start saving, then either the less you need to save per year to retire, or the sooner you can retire, right? So either one of those two things is true, and I'll show you this here in a moment. I think the other thing that's important is just gets you in the habit of investing, right? So when you get your first job and you're 22, you can just start saving right away. So instead of spending all the money that you have and getting used to that lifestyle, and then having to roll back after you want to start saving, you could just start saving right away and not really kind of know how much extra money you'd have to spend on whatever trip you want to take now or whatever movie you want to go see. All right, so that's a good way to get started. So just to show you why it's important to start early. So this graph shows you how much you have to save per year if you want to retire a millionaire at 67. All right, so this shows you how much per year you'd have to save with an average return of 8% if you want to retire a millionaire at 67. So if you start right after you graduate here at UCI, I know many of you have already graduated, but if you just graduated and you start saving this year, if you saved about $2,500 per year, you would be a millionaire when you go to retire. So just $2,500 a year, and you'd be a millionaire. All right. So just to put that in perspective, if you divide that by 12, that's $200 a month. If we divide that by 30, that's about $7 a day. All right. So most of you are probably paying almost $7 a day for a cup of coffee when you go back to work. So literally, if you stop buying Starbucks every day, you can be a millionaire when you go to retire. In fact, if you pay $6.50 for a latte at Starbucks every day, by the time you retire, you'd be a millionaire if you put that in savings instead. By the time you get to 30, that's doubled. You have to now save $5,000 per year. By the time you get to 40, that's more than doubled again. You got to save about $12,000 a year. And you can see by the time you're 50, you have to save about $30,000 a year if you want to retire a millionaire. All right. So the sooner you get started, the sooner money can make money, and the sooner that you're going to be able to retire, or the less money you need to save to retire. Right. So today is the best day to get started. All right. All right. So we know why we want to invest. You're saving. What should I invest in? All right. So there's two securities that almost always you're going to invest in as I'm going to call it as an amateur investor. Like, I'm not even a professional investor, right? I don't run a hedge fund or a mutual fund or an ETF, or I'm not Kathy Wood, if you've heard of her. All right. I'm just a plain old amateur investor. And so the two things that I typically invest in are something called stocks, which are also known as equities, and bonds, which are also known as debt. All right. So you hear these terms thrown around all the time, and you're probably wondering what these things are. In fact, the number one question looked up on Robinhood in their FAQ is, what is a stock? Right. So the number one question that's asked of Robinhood is, what is a stock? And so we're going to talk about what a stock is tonight. Probably the easiest way to think about what stock and debt is to think about buying a new car. All right. So it's to think about buying a new car. All right. So one of the biggest and most popular investments on Robinhood, and of course, one of the most popular investments by Gen Z folks and younger folks, is Tesla. All right. So imagine you do the opposite of what I tell you to do, or maybe you're lucky and you inherited money. You know, my great great uncle is Milton Hershey, but he gave all his money to an orphanage. So now I just eat the chocolate and lecture. But you can see here, you know, so maybe you have a trust fund, I don't, but you know, if you don't, you know, maybe you don't follow my advice and you go out and you buy a Tesla Model S Plaid Edition, which amazingly you can go to 0 to 60 in less than 2 seconds. One of those babies will cost you $135,000 to buy it. All right. So there's two pieces to this when you buy it, right? If you want to buy this Tesla, you have to come up with $135,000. All right. You could think of the amount of money of your own money that you used to buy the car. All right. That's your equity. All right. That's how much money you put into the car. That's called your equity, or that's stock. All right. How much you borrow from the bank to buy the car is called your debt. All right. That's called your debt, or that's called bonds. All right. So in this car, we're going to put $35,000 of our own money in the car. That's called equity. And we're going to borrow $100,000 to buy the car from the bank, and that's called debt. All right. Now let's go see what happens here if the price of the car right after we buy it changes. All right. So just imagine you buy this car and the price of it changes. It could be that the price crashes because we find out that autonomous driving is never going to work. It could go through the roof because Tesla has production problems and there's always so many of these Plaid S's that are going to exist. All right, so over here I have different values of the car. So remember, you bought the car for $135,000. Instantaneously, the price of the car changed, right? So this is the price of the car, different prices all the way from nothing. So the value of the car goes to zero, all the way up to the car becomes worth $225,000. All right, you can see here, no matter what happens when you borrow money. All right, so some people, maybe you borrowed money for student loans or to buy a car or buy a house. No matter what happens to the value of your car, you owe the bank $100,000. All right. So no matter what happens to the value of the car, in theory, the return on debt is zero, right? The bank makes sure it loses zero money. And then you can see what happens to the value of the equity, right? So the value of the equity is simply the value of the car minus the debt, which gets you the value of the car. So at $150,000, you owe the bank $100,000. That means the value of the equity is $50,000, right? If the value of the car goes to $225,000, the value that's still $100,000, which gives the value of the equity $125,000. All right, so you can see here that debt always gets paid before equity. All right, debt always gets paid before equity. Equity is actually known as the residual claim. It gets left over after everybody else gets paid. So if you're an employee of the company, you get paid before equity holders get paid off. The IRS gets paid first, right? Suppliers get paid first. Everybody gets paid first. You can see the same thing here. And then you can see what happens to the value of your equity. So if this car goes to $225,000, you pay back the bank, you sell the car, you have $125,000 in your pocket. You paid $35,000, so that means you made $90,000. Divided by 30,000, you can see your return is 257%. All right. So of course, if the value of the car goes to zero, in theory, you owe the bank $100,000. You lost $100,000. You invested $35,000. You can see your return is minus $400,000. right? So the two things you can see here that are important is one, debt always gets paid before equity. So equity is more risky. If you buy stock in a company, it's more risky than if you buy bonds, all right? And you can see also, of course, here that you can see this in the returns, right? So you can see this in the returns on equity, right? They're much more risky. All right, but wait, there's one problem with this, all right? If your car was actually worth $0, just imagine you bought this Tesla, you took a $100,000 loan from the bank, and your car was worth nothing. Would you continue to make payments on your car? Would you actually pay back the $100,000? Of course not. All right, you never do that. Oh, hell no. There's no way you'd pay that car back, right? You would just turn it back over to Tesla and tell the bank to have fun getting their $100,000. All right, so this is the more realistic way that we do debt. All right, and so this actually should be 0 here. Of course, I didn't put the 0 in, so I like to get the first typos over early. So this would be 0, 25, 50, 75, all the way up. But you can see here what happens is after you lose all your equity, all right, so after the car goes down to 0, all right, then you can see obviously that you stop making loan, and it's possible that the bank can also lose money on your car, right? And the reason the bank can lose money on the car is because if you stop making payments, you hand the car back, the car's not worth anything, and the bank loses all of their money. All right, so again, I have a little typo here. This should be 0 and 25 and 50. All right, but you can see your equity value will never be less than 0. Once equity goes to 0, the debt starts taking on losses. And the other thing to note here is once the car is worth nothing, all right, the bank can't tell you what to do with the car, right? So you can imagine, I can imagine lots of fun things I do with a car that's worth nothing. You know, I might go on a joyride down the 405 or the 5 or whatever. Of course, I'm not recommending that. That's against the law. All right, or maybe you take it to a test track and you wreck the car and it becomes worthless. You can just hand back the wrecked car to the company, to the bank. All right, so you can do whatever you want. All right, so the takeaway here is if we look at debt versus equity, you can see here that debt is less risky than equity. Debt can default if the value of the company goes to 0. And you can see, of course, all the other things that go on here with debt. There is one kind of debt that will never default, and that's the debt of the US government. The question is, why will the debt of the US government never default? And the simple answer is because they can just ask you for more money, right? The US government will never default because, of course, they can just give you more money. They can raise your taxes. That's how they get more money from you to make sure they can pay their bills. All right, so companies can default on their debt just like you could default on your car, but the US government debt in theory is something known as risk-free, right? It's a risk-free investment. All right, so again, the takeaways here, bonds, debt are less risky than equities. They have less downside and less upside. Majority returns are from interest payments, all right? So when you have a debt, you basically get interest payments every month like you make on your student loans. That's how you get money. For companies, you have less chance to lose money through defaults, but you still can lose money if companies can't pay you back. You have something called a maturity date. So if you think about a car loan, a student loan, a mortgage, right? They only last a certain amount of time. So at some point they end, and they're typically used to diversify your portfolio. All right, since they're less risky, we're going to see they're typically used to diversify your portfolio. If you buy stock or equity, which again, if you turn to anything that's anything anyone talks about, it gives you ownership in the company, right? So in other words, you can do whatever you want with the Tesla. If you own the stock of the company or you own the company, you can do with it whatever you want. It gives you higher return potential, but higher risk, right? So you can see with the returns on the Tesla, it's always minus 400 to 200 or 300%. And you hope your company lives forever, right? So the idea here is there's no maturity. A company can go ahead and live forever, right? So that's debt versus equity. So I talk about the Tesla, just change the Tesla car for Tesla the stock or Tesla the company, right? So Tesla has debt, Tesla has stock. You either get GE, you can pick whatever favorite company you have and put those in there for debt versus equity. All right, again, just to show you in reality that stocks are much more risky than bonds. So again, this is the annual stock return that we have for the last 50 years. So you can see a couple of times stocks have lost 20, 30, 40% of their value. So they're riskier. Just to give you an idea, this is a bond portfolio, right? So you can see here bonds are much less risky, again, back and forth. See, bonds are much less likely to lose money, all right? But they also have less upside, right? So you can see stocks have more upside, right? In fact, if you compare the returns of debt to stocks, bonds to stocks over the last 50 years, if you invested 100% equities over the last 50 years, you'd end up with 4.5 million. If you invested 100% in the bonds the last 50 years, you'd only end up with about $1 million, right? So there's a gap here about 3.5 million, all right? So the bottom line here is equities offer you higher returns, but equities have a lot more risk, all right? You can see that here in the graph, right? Where you have these big crashes and how much your portfolio is worth, all right? So you can make more money, but you can lose more money. And that's an important thing to remember here as we start putting together our portfolios, right? So that's bonds versus stock. All right, so I'm going to go a little bit quickly through this part here. So, basically you're saying to yourself, well, if I would lose $3.5 million, then why would I ever own bonds? All right, why would I ever own bonds? And there's two reasons you might own bonds. There's lots of reasons, but I'm going to focus on these first two really quickly. So the first is called risk tolerance, and the second is age horizon, or your investment horizon. I'm going to show you why these two things matter here very quickly. All right, so risk tolerance. So usually what you do, the first thing is if you go to talk to a financial advisor, they're going to ask you to take a risk assessment test. All right, a risk assessment test. So they're going to see how much risk you're willing to take in your portfolio. All right, so this is one of the questions that they'd ask you. You're on a TV game show, and you can choose which of the following. All right, which would you take? $2,500 in cash, 50% chance of winning $5,000, and 50% chance of getting nothing. 10% chance of winning $30,000, 90% chance of winning nothing, and a 2% chance of getting $200,000, and a 98% chance of getting nothing, right? Of getting nothing. So those are your options. All right, just to do this real quickly here, how many people would do the first one? Give me a hand raise if you do $2,500 in cash. All right, got some people here going quickly. All right, we got lots of people here. All right, so let those one go. Oh, I see some familiar names out there, so it's nice to see that. All right, how many people would take the 2% chance of making 200,000? Anybody take this bet? All right, so nobody voted, by the way. I didn't get one hand up for 2%. So this is called a risk aversion test. So these people here that choose this option, we call them risk averse people, right? So they're scared about losing their money. They're more scared of losing money than making money. And these people we call risk seeking. All right, so these are the people that play a lot of blackjack. They may play the lottery. All right, so these are the folks that can tolerate a lot of risks, right? They don't mind losing a lot of money. It doesn't keep them up at night. All right, so the first thing you do is you take a risk assessment test. All right, and the more risk aversion you have, all right, then the more bonds you're going to own in your portfolio. All right, the more bonds you're going to own in your portfolio. All right, so again, this is really important because you have to know how much risk you can take. All right, because how much risk you take drives your return, right? If you can tolerate 100% stocks, you make 4.5 million. If you can't tolerate stocks at all, you make $1 million. All right, and of course, but it makes it harder to sleep at night if you have all those stocks. So just to give you an example, so this is last year. All right, this is last year, right? So this is the beginning of the sell-off last year, and I know everybody knows the stock market did well, but just imagine you're doing this in real time. So you have $1 million portfolio. All right, and this is in real time here. So you've lost $25,000 in your portfolio. Do you sell it now? Probably not. Well, now you've lost $35,000. Do you sell now? Maybe. What if when you've lost $80,000? Do you feel like selling? Or maybe $90,000? Or maybe $160,000? Or maybe $240,000? Or maybe $270,000? Or maybe $270,000 again? Or $300,000? Or $325,000? Right, so you can see what happens here is if you're risk averse and you own 100% equities, this would be your experience last year as the market's crashing. And at some point, you're going to say, holy crap, or you're going to panic that this thing is going to go to zero and you're going to sell. All right, in fact, I'll tell you about this later, but my mom sold right here. That's where my mom decided to sell. And of course, this was the bottom of the market right there because my mom has a really low risk tolerance. All right, so you got to know your risk tolerance so that you can set yourself up so you don't sell here. All right, you want to set yourself up emotionally where you're not worried about how much you lose, and so you don't sell at a particularly bad moment in time. All right, you don't sell at a bad moment in time. All right, and so you can see here, this is the portfolio I showed you. This is 100% equities. And this is what would have happened last year if you had bonds, right? In bonds at this time period, you're down 32% in your stocks. Bonds are actually up 5%, right? They're actually up, all right? And you can see these different mixes. So what you do is you mix in bonds to make your portfolio less risky, have less downside, so you don't sell at a particularly bad moment, right? So most of us should have 100% in equities, right? If you're 22 years old, there's no reason to have 100% and bonds. There's actually almost no reason to own bonds. But the issue is if you sell your stocks at a bad time, then you made a really bad investment decision, all right? And that's why we use bonds, right? The second thing is time horizon, all right? So time horizon. So the reason time horizon is important is just imagine that you're retiring next year, right? So you've turned 66 years old, you've worked your entire life, and you're going to retire next year. And so you're looking at your portfolio. And so this kind of gives you your 1 year time horizon. So this is the graph. This is your returns that you could have if you own stocks for 1 year. And this is the returns that you could have if you had bonds. All right. So just to give you an idea here, from 66 to 67, when you go to retire, bonds, there's only a 2% chance that you're going to lose money. Bonds, equities, there's a 26% chance you're going to lose money. In stocks, it could be that you lose 44% of your retirement savings in 1 year, all right, the year before you go to retire. In bonds, your maximum loss is 3%. All right, so the idea here is if you have 1 year to retire and you're going to take your money out in 1 year, then you probably don't want to own stocks because you probably don't want to lose 44% of all of your savings the year before you go to retire. All right, for time purposes here, I'm not going to go through each one of these, but you can see the 5-year time horizon, you can see your probability that you lose money in stocks goes down. If you look at a 10-year time horizon, you can see your probability you lose money with stocks going down, it decreases. And by the time you get to 20 years, you can see here that your maximum probability of losing money in stocks is 0. Right. And in fact, you can see here the median expected return over a 20-year horizon is 800% return on your money versus only about 200% return for bonds. Right. In fact, your maximum, the minimum amount you'll make over 20 years historically is 60% versus making only 33% for bonds. All right. So the longer that you have out to go out there, if the market crashes, the more time it has to recover and give you a positive return. But if you only have 1 year to go, then it's probably very, very risky to go ahead and hold a bunch of stock 1 year before you go to retire. All right. All right. So conclusion on what to own. If your risk can take it when you're young, you should probably have 100% equity. So if you're more than 20, 30 years from retirement, you probably should own 100% equities. If you're risk averse, just own the most equities you can without forcing yourself to sell. Right. So just take your maximum where you can handle it without sleeping at night. And then as you get older, so when you turn 50 or 55, then your time horizon goes down. You need to think about making a less risky portfolio and owning more bonds. All right, how to own it. All right, how to own it here. So I got about 15 minutes to go here. So how to own it, mutual funds or ETFs. So you probably heard these two things thrown around, a mutual fund or an ETF. They're basically the same thing. All right, what a mutual fund and ETF is they are a diversified portfolio of either stocks or bonds. All right, that's the easiest way. You can get ETFs on gold and some other stuff. Remember, I'm just focusing on stocks and bonds here. All right, they're the easiest way to get exposure to a broad market. All right, there's the easiest way to do it. All right, so there's mutual funds, ETFs. For you, they basically don't make a difference. The one thing that you probably want to think about is if you want passive or active. All right, you want probably passive ones. They follow an index. Someone's not trying to beat the market like Kathy would. All right, you just want a passive because they're cheapest. Right. And so I'm just going to go with the lazy recommendation is you can go with the Vanguard Total Stock Market Index. There's a mutual fund and an ETF for that, and the Vanguard Total Bond Market Index. All right. And you can just put in, for you, it should be almost 100% in this, and then maybe, 10%, 90% in 10, 80, 20, 100, 0. And you can literally just use those two vehicles to make your entire investment for your retirement. You don't need anything fancier than that. All right, if you save and you use these two things and you don't sell when the market goes down, you're going to do great. All right. If you have a 401k, a 403b, 457b, whatever you have, they probably don't use Vanguard, or they might not. They use Fidelity. They might use Prudential. They might use somebody else. But chances are they're going to have the same options for you to pick from. All right. So just to give you an idea here, this is my menu that I have here at UCI. All right, and you can see I have a UC domestic index. All right, so this is basically the total stock market index, and you can see I have a UCI bond fund here. All right, so those are basically the two that you want to play with. All right, as I mentioned, you would probably want to avoid active funds. All right, so an active fund, you have a manager that's sitting there trying to buy stocks and beat the market. As I'll explain to you later on, it's really hard to beat the stock market. All right, and these managers are really expensive. So if you have $1 million in your portfolio, on average, to employ a manager in a mutual fund or an ETF that tries to beat the market, it'll cost you 1%. So every year, essentially, they take $10,000 out of your portfolio to try and beat the market, right? That's their fee to you to try to beat the market. If you invest in a passive index or a passive fund like those Vanguard funds I told you, you pay about 0.02%, right? You pay about 0.02%, which I believe is about $200 a year. All right, so you can see, there's a big difference between $10,000 a year that comes out of your account and $200. All right, so again, avoid those active funds that are really expensive. You want to go to the passive funds that are cheap. And so if you want to see if something is cheap or expensive, there's something called the expense ratio. That's what you want to look at when you pick your funds. All right, target date funds. There's a lot of target date funds out there. Target date funds are okay. If you really want to be lazy, so they basically, you pick the year you're going to retire, and then they move your stocks and bonds down over time. The challenge with those is typically they have high fees because you pay fees on the target date fund, and then that funds invest in other mutual funds which also charge fees. So you pay double fees. So you don't have to change your allocation that often. If you just go in once a year, as you get older, you can make that change for yourself. Right. All right. Last point here, and then I'll do a couple FAQs and we'll talk about stocks for a little bit. No matter what you do, all right, get all the company match you can. So if you work in a company that matches your retirement contributions, the first thing you should do, no matter what you do, before you pay off anything except your credit cards, you should always pay those off first, is make sure you take full advantage of your company match. All right. So what a lot of companies do that do matching is what they do is for the first 6% of your income that you put into your retirement account, they'll put in the same dollar for dollar match to you. They call this full match for the first 6%. All right. So you can see the example is if you make 60K per year and you put in 6% or 3,600, your company will also put in 3,600. So basically this is like you put in $7,200 in your account. All right. This is like getting 100% return immediately. All right. So if your company has a match, make sure you take full advantage of it as soon as you can. It's free money. Even if they do a 50% match, you're getting a 50% return for free. All right. So before you do anything else, minus paying off your credit cards, make sure you're fully taking care of your company match. If you're not able to do that right now for whatever reason, one tip that I heard from a friend of mine, which is really smart, is every time he got a raise, half of his raise went to going into his retirement account and half his raise went to him. And I thought that was really smart because, you get used to your current level of income, you use a little bit to make yourself a little better off, and then do a little bit to save a little bit better. All right. So make sure you take care of that company match. A couple of quick FAQs here. Do I need a financial advisor? Unless you have a lot of money or something really weird going on, no. All right. So financial advisors are great. I run a wealth management center. Unless you have a lot of money, you can just do exactly what I told you. You can manage your own retirement. Financial advisors are great if you have a lot of money because there's tax things you can do and estates and trusts and everything else you have to worry about. But unless, if you're just I'm going to call a normal person like me, you don't need a financial advisor. Again, they charge like 1%. So they take 1% of your money every year as a fee. And if you're down at a certain level, you really don't need the services that they're going to provide. There's a place for them, and maybe you need one, but if you're just starting saving for retirement, you probably don't. What's the difference between a regular and a Roth IRA? All right, so the easiest way to think about this is in a Roth IRA, you pay taxes today on the money, and then you put it in the Roth account. When the money comes out of the Roth account, it's tax-free. On a regular 401k, you put the money in now as pre-tax. So every dollar you put in, that's one less dollar you have to pay taxes on this year. But when the money comes out, you have to pay tax on it. Which one is better or worse really kind of depends on your tax rate. So if you have a very low tax rate now, typically use a Roth, right? So if you put $1 now and only pay 10 cents in tax and you get to put 90 cents in, that's great. You do that because then on the outside, when you have a lot more money, you'd have a higher tax rate and vice versa. All right. What if I want to get rich really fast? I don't want to work anymore. I'm sick of my job. And that goes back to the gambling versus investing caveat I put at the beginning. All right. So just wrapping it up here. Oh, so one last thing here before I forget. What's going to hurt your investments is pretty much panic and FOMO. These are the things that are going to kill your investments the most. All right. It's the worst thing you want to do. All right. In fact, I have a friend who's really smart and is all caught up in crypto FOMO right now. Don't get caught up in these two things. They're going to make you do terrible stuff. Just to show you real quickly here, why you don't want to do this is literally no exaggeration. This is from my mother. This is exact timing. So top of the tech bubble, every day stocks go up. I'm selling all my bonds and buying stocks. She really did all of this, by the way. This is all true. At the bottom, after everything's blown up, the stock market is rigged. I'm selling everything. Then in 2007, the NASDAQ is at new highs. Finally, I'm buying. End of the world at the financial crisis. I guess it's safe to get back in again. And then she sold in March 20th, as I told you last year, after I begged her not to. And so you don't want to be this person, right? This person is buying high and selling low, and it's not even getting close to the return they could. All right. And you can see here, if you go through the average returns for 401k. So this is literally average return data for 401k. This is the return if people buy and hold equities. And the red bar here is the bar that people actually earn. Right. So people sell at the top, buy at the top and sell at the bottom because they let emotions take over and then they make bad decisions. So whatever you do, when the stock market is crashing, that's the time to buy more stock. All right. Just think about your favorite store. When everything's on sale, 40% off, you go and buy more. All right. If they raise their prices 40%, you wouldn't buy anything. But for whatever reason, as investors, we like to buy things that are expensive and sell them when they're cheap. All right, and we should be doing exactly the same as we do when we have our stores, all right, where we go shopping at our favorite stores. All right, so investing conclusions. It's really not hard to invest. All right, you got to save money. You got to know your risk tolerance. You got to figure out your timeline. And then really kind of the trick number is you take 120 minus your age, and that's what you should have in equities, right? So if you're 22 years old, 120 minus 22 is 100%. You should have 100% equities. If you're 50 years old, 120 minus 50 means you should be in 70% equities, 30% bonds. So that's the easy way to do it. The hard part, actually saving money is always hard. Being patient, right? When you put in that first $2,000 when you're 22 years old, and the next year goes up to $2,160, it seems like you're never going to get there. You just got to be patient, and it will get there. And avoid bad emotional decisions, right? Those are the things that really kill you when it comes to investing. All right, I got about 10 minutes to go. And so I want to talk a little bit about stocks trading, right? So far I've been talking, basically you want to own a broad index of stocks picked for you by an index. So what happens if you want to be a trader, right? You're super excited about trading. You want to be a trader. And to quote Liam Neeson here from Taken, I just wish you the best of luck. All right, the best of luck, because remember this line from The Big Short. This is Wall Street, Dr. Burry. If you offer us free money, you are going to take it. All right, you are competing against millions of other people who are really smart. Just to show you how smart they are, Goldman Sachs has a real-time satellite. I kid you not. They actually have a real-time satellite that flies around and does reconnaissance for them. So back like 5 years ago, they had a satellite parked over the Foxconn factory in China, counting the number of trucks that left the Foxconn factory to estimate how many iPhones Apple was selling. Why do you think you should beat Goldman Sachs? And if you can't answer that question, then you shouldn't be trading stock unless you're doing it for fun. All right, that's the bottom line. So why do you want to trade? All right, so trading has become incredibly popular the last year and a half. All right, it's probably because, you get the FOMO, all these people have been making money buying ridiculous stocks, as we'll talk about here a little bit, or you're just bored to hell. All right, so I had this thesis that Robinhood became very popular because people want to gamble. Actually, my new thesis was that people were just bored and they were looking for something to do. All right, so just to show you that you are not alone, in my last 2 Ubers, this is literally the conversation that's taken place. I'm like, hey, how's your day going and what do you do? And they're like, oh, my second job is Uber driver and I'm just getting out for a while. My first job is day trading. And they asked me what I do. And I said, oh, I'm a finance professor. And then they proceed to lecture me on financial markets, right? So that's probably not a good sign about the markets. I have a staff colleague of mine, nothing related to finance, never bought stocks before, asked me for trading tips. I have a faculty colleague of mine that is not in finance who was caught checking his Coinbase account during the break when he was teaching on Zoom. I have people at home explaining to me equities on LinkedIn that are stay-at-home dads, not that there's anything wrong with that. A marketing executive, and even my mother is taking time, who is the worst investor of all time, to tell me how things work. And by the way, this is the highest registered webinar ever outside homecoming, which probably tells you that stocks have a lot of attention. All right, so stocks are very busy. All right, so I'm going to skip that just for time. So there's a million ways to trade. All right, I have a whole list here. If you're a trader, you know probably what some of those things are. If you're not a trader, you probably don't know what those things mean. And if you don't know what those things mean, that's fine, right? There's lots of different ways to trade. So I'm not going to sit here today and tell you how to trade. I'm just going to tell you all the things that you're going to do wrong when you trade. All right, these are all the things that you're going to do wrong. All right, and I want to tell you these in advance so I don't have to do the Stephen Colbert and put up a big banner that says "I told you so" in like a year or 2 years from now. That's the last thing I like to do. All right. So first off, it's incredibly hard to beat the market. Right, you're probably going to lose. All right, maybe you win in the short term. Maybe you guys bought some GameStop at like $30 and it's at 200 today. Maybe bought some Dogecoin or whatever. But in the long term, you're probably going to end up losing. All right, look at Kathy Wood. If you don't believe me, look at ARKK ticker. And she did amazing because she bought all these incredibly high risk stocks and now they're crashing this year. 80% of professional investors can't beat the market. Right, 80% of professional investors can't beat the market. They did a column back in the late 1990s in the Wall Street Journal called the dartboard column. They had analysts compete against monkeys who threw darts against the Wall Street Journal, and the monkeys won like half the time. All right, so basically it's like throwing darts at a stock board. And for individual investors or retail investors, it's even worse. These investors tend to pay way too much attention to in-your-face information. They tend to herd into the same stocks, and they tend to be way too emotional about how things are going. Okay. Your biggest mistake that you'll make as a trader is you buy something because the price went up. Buying something because the price went up is not an investment thesis. Buying something because everybody else bought it is not an investment thesis. In fact, buying something because it went up and everyone bought it is a surefire way to quickly lose all of your money. All right. Everybody does it. Everybody buys stocks they know. We have stock market competitions here on campus. Everybody owns Amazon. Everybody owns Apple. Everybody owns Tesla. They buy things that go up in price. They buy things that Elon tweets about. I have no idea why. The guy got fired from PayPal, and then one day he'll get fired from Tesla, I'm sure. All right. But what happens to the price of something when everyone buys it? The price goes up. And of course, what happens after everyone buys it? If you buy a price high, you get low returns going forward. All right. So don't buy something because the price went up. All right. Don't buy something because the price went up. It's the biggest mistake you can make. All right. So this is just to give you some examples of how this is going to script. So this is DDD. They were the largest 3D printing company. You guys remember 3D printers were hot? Maybe like 5-10 years ago. So this is their stock price. They went from $1 to $95. They had a 9,400% return in like a 2 or 3 year period. And you can see what's happened after, right? Everybody jumps in. They got super excited about it because 3D printing is the future. And, you know, I'm going to make a car with a 3D printer or some other ridiculous thing. And of course, they end up crashing. And people do this on Robinhood every day. All right. So I have a research paper on Robinhood. Robinhood used to release their data. All right. So this is the date that all Robinhood users heard because for the price of the stock went up, right? So price of the stock goes up. Everyone on Robinhood buys because they're super excited. The price of the stock went up. And then you can see the price goes down over the next month. In fact, just to show you this more clear, the day afterwards, so if you buy what everybody bought on Robinhood, on average, the next day, you've already lost 1.2%. And by the time you're out 2 weeks, you've lost, or 3 weeks, you've lost 5%. If you buy everything that everybody buys on Robinhood every day, and you do it every day, so you sell and then buy the next day, and then sell and buy the next day, you turn $1 million in 2018 into $1,000 2 years later, right? Because everyone buys the same crap, price goes up, everyone herds, the price goes too high, and then it crashes afterwards, right? And then 1% doesn't sound like a lot, but if you use 1% per day for 243 trading days per year, it doesn't take you very long not to have all your money. Right. So don't buy things that because the price went up. That is not an investment thesis. And that, in fact, that's a way to get you in trouble. Right. Number two, even for good stocks, price matters. All right. So the chat's on here. There's lots of stuff in the chat. Anybody want to guess what? By the way, I have no positions in individual stocks. Someone said I'm short Tesla. So for the record, I don't have any shorts in Tesla. I don't have shorts in anything. I don't even own an individual stock. I have all index funds. So I have no skin in any of these games I'm talking about. In fact, I own Tesla because Tesla's in the S&P 500. All right, anybody want to guess what stock this is? I got GME. Anybody want else? I'll give you another like minute, 30 seconds. Give me what you got. What do you guys think this is? Volkswagen, GMC, IBM, Coinbase, AMC, GME, Starbucks, because of Frappuccinos, that's a good one. AMC, everybody thinks this is AMC, right? IBM, because I mentioned at the beginning. Tesla, nope. This is Amazon. So this is Amazon. So Amazon went from nothing to over 110 during the tech bubble and crashed 97%, right? And it took 10 years to get back to where it was. Amazon was for a little while last year the most valuable company in the world. But if you bought Amazon at too high of a price, you have a really low return. So price matters. Like when Tesla was the most valuable company, it was worth more than all of the other car companies in the world combined, more than Toyota, plus Nissan, plus Volkswagen, plus BMW, plus Mercedes, plus Subaru, plus whoever else you want to do. Maybe the price of Tesla is a little bit too high, right? So my point is, even if you think there's a really good stock to buy, all right, price matters. All right, price matters for what you buy in the stock. So you might be wondering how I trade, because I just told you that I don't own any individual stocks. I don't have any skin in any of the stocks that I'm bashing here. All right, and I got 2 minutes left. So we'll do Q&A here in 2 minutes. So if you got some questions, go ahead and throw it in there. All right, I'm only active. I only trade a small part of my portfolio because I know I'm not going to beat the market. I do it for fun. I make some sector bets. All right, I don't make all my moves at once. And even if I lose, my losses are small. All right, so my equity portfolio that I trade, I own equities, right? So if I end up being underperforming, it's relative to the index and it's really not that much. All right, so I actually look at sectors and areas as they get mispriced rather than trying to pick individual stocks. All right, so for example here, I try to think different. I'm a contrarian investor is what they call me. All right, so last year, everybody was buying tech. This is the Dow versus the NASDAQ back from 1992. So a lot of you might be too young. In fact, just almost 30 years ago now, so probably a lot of you weren't alive. This is the tech bubble. So this is the ratio of the NASDAQ, which is all tech stocks, versus the Dow, which is all non-tech stocks. I know Apple's in now, but you can see the ratio here got crazy out of control. And of course, it came back down to earth. You can see the same thing happen when COVID happened. In fact, right now, the NASDAQ would have to underperform the Dow by about 25% to get back where it was. And that's already started to happen. All right. If you look at growth versus value, the same thing, right? Everyone's excited about Netflix. Nobody cares about Triple M, right? 3M. Nobody cares about it. All right. But my question to you is, who's going to subscribe to Netflix if they don't subscribe to it now? If you haven't got on Netflix by now after 15 months, I mean, they have no growth left. They pulled it all forward. Right. So I look at things like this, where I look at relative value. Right. And so I would compare growth value. That's how I trade. But I don't trade a lot, because the one thing that you're going to forget to do is the value of your time. Right? Time's expensive. If I spend 3 hours a day trading and I make like a 0.5% alpha on, even if I had $1 million, that's like $5,000. Like, who cares if I make $5,000 trading if it eats up three hours of every one of my days? That makes no difference, right? So just be careful with your time. So my most controversial comments of the night is, they asked me to come back and talk about crypto, but I'll just talk about it in a minute here. All the following are not true. Crypto is not a currency. It's not rare. It's not investing. It's a waste of environmental resources. It's all the same bet. An investment thesis is not that Elon might tweet about it, and all cryptos are probably going to eventually be worthless, minus say Bitcoin, because Ether and Dogecoin and all those have an unlimited supply. So people can keep making Ethereum and Dogecoin until the cows come home. And so if you can make an infinite supply of nothing, the value is zero. That's what everyone argues about the dollar, right? There's over 5,200 cryptocurrencies right now. 5,200. There's only 180 real currencies and 3,700 stocks that are traded, right? So if you want to say that crypto is the future, my argument was maybe Bitcoin will be here, maybe Ether will be here, maybe Ripple will be here, but that means that 5,196 of these won't exist in a few years. All right, and I do know the difference between those, Jacob. Thank you very much. I'm excited to have people lecture me about how this stuff works. So I'm very excited for that during the Q&A. All right, so here's Bitcoin returns. This is not investing. This is gambling. Here's Ether returns. This is not investing. This is gambling. All right. And so anyway, so just remember, Bitcoin crashed before. So in 2018, Bitcoin was down 83%. So Bitcoin can crash just like everything else. Bitcoin may go from 65,000 down to 6,500 again and getting crashed. All right. And the question is, do you head back? Are you going to hold it that whole time? Right. This is not that long ago. So December 17 to December 18, Bitcoin went down by 83%. All right, so investing is an important part of your financial health. Start investing as soon as you can. Make sure you take appropriate risk for you. Don't get emotional. If you want to trade, don't expect to get rich, and just don't make the common error. So I don't care if people trade, have fun. I enjoy trading, but I also make sure I kind of have my own style that I do things, and I don't try to replicate other people. All right, we know that Jacob owns a lot of crypto. That's what we've learned from the chat so far. So all right, let's go ahead. What do we got for Q&A?
All right, we have a ton of great questions. The first one I'd like you to address is, there is a 25-year-old anteater, and they want to know, should they have low-risk investments like bonds and mutual funds, or what should their portfolio consist of at 25 years old?
Sure. So just to clarify, bonds and mutual funds are not the same thing, right? A mutual fund is a way to invest in bonds. Right. So you can think about mutual fund as a container, and that container can either have like bonds in it or it can have stocks in it. Right. So a mutual fund can have bonds or stocks. In fact, the Vanguard Total Stock Market Index is a mutual fund that has stocks in it, and the Total Bond Index is a bond index that has bonds in it. If you're 25 years old and you're saving in a retirement account, all right, you should own almost all equities. Right. I don't not necessarily think equities are cheap right now. But the way I think about it is, if you're going to retire at say 55 years old even, right? If the stock market's not higher in 30 years than it is today, you're not going to be able to retire anyway. All right. So you might as well take the risk that you can and get that higher return. So if you're 25, definitely, make sure you own some equity mutual funds. You can have some bonds, but it should be mostly equity mutual funds.
Okay. Thank you. Thank you for answering that. And then the next one, it was in the chat a lot. They're curious why AMC and other stocks are considered more of a gamble than other stocks in the market.
Well, I mean, we could talk about meme stocks and all this other stuff. So, I mean, basically AMC and GameStop are stocks I'm going to call them toys. All right. I'm going to call them toys. Right. And the reason they're toys is because you have a community of people who just trade them for fun. Right. They just get on there and they want to push the price up to screw over hedge funds or whoever else they think they're going to screw over. They're not buying them because they think it's like a good long-term investment thesis. They're buying them because they just want to try to screw someone else over. And you can see that if you look at a normal stock, like just pick GE or P&G or even Tesla or something else, I mean, they're not nearly as volatile as GameStop or as AMC because they just don't have this herd of people that are just pushing them around for fun. So that's why they're really not called like real investments, right? So in the stock market, you have something called like liquidity. So if everybody goes to buy the same thing at the same moment in time, the price is going to shoot up, right? So when you coordinate this trading, that's really what makes the price goes up, and of course the price ends up coming back down. So I think GameStop's been up to what 450 twice already this year. It's at 200 a day just because for no reason. Like if a stock goes up 20% on no news and no reason, it's just a game. And I don't know, frankly speaking, why the regulators don't do something about it, but that's a different story for a different day.
Great. So the next one is there's a lot of
talk. Let me
talk.
clarify. I do know the story, Zach, of the short squeeze, but at this point, the short squeeze is over, right? So that's what I mean. Go ahead. Sorry.
Oh, it's all good. So there was a lot of chat about inflation. So someone had a question: is what's a good hedge against inflation? Is it gold, cryptocurrency, silver?
Yeah, that's a great question. So, typically speaking, during inflation, what we're called real assets do well. And what we mean by real assets are commodity companies, because they mine real assets, right? Real estate typically does well during inflation. Companies that have pricing power, right? So I think everybody here is going to brush their teeth unless the price of toothpaste goes to like $500 or something. So typically consumer staples, things we need to survive, are things that typically do well in inflation. The things that don't do well in inflation are tech. And the reason is because tech by itself is deflationary, right? So the value of the computer that you purchased every year goes down. Often when you do IT contracts, the price goes down over time rather than going up. So they're almost like deflationary. And so usually things like hard assets, consumer staples, bonds don't do particularly well. So you want to stay like more Dow Jones type of stocks.
All right, the next question is, what's the VTI equivalent for Fidelity?
VTI equivalent for Fidelity. Here, I'll look that up. Why don't you ask me the next question?
Okay, and then someone wants to know if you can go into a little more detail about a Roth IRA, and if it's worthwhile to make one.
Hold on, I'm looking up the Fidelity Total Market Index. Let me see if I can do this quick. While we're doing so, the difference between so there's a couple different things here, right? So an IRA, Total Market Index Fund. So the ticker for Fidelity is FXKAX. So FXKAX is the Fidelity Total Market Index Fund. So that's the fund that you're looking for. All right, so a Roth IRA, so the difference between an IRA and a 401k is a 401k is offered through your employer, right? So your employer offers a 401k. So here at UCI, we are a nonprofit, so we have a 403b, right? We have a 403b, which is the same thing as a 401k. An IRA is something that you can set up yourself, right? So you go to E-Trade or Ameritrade or whoever, and you set up an IRA. And so that's something you can set up yourself. You don't need your company to do it. And so it's the same as a 401k, it's just you do it individually, all right? And so again, there's still two kinds. So there's a Roth IRA and a regular IRA. And again, that comes back to the tax advantages of them, right? So if you have a Roth IRA, when you put money in today, it's after you pay taxes, right? So let's say you make $1 and you pay 30% tax. So then like the 70 cents you have after tax is what you put in your Roth IRA. And then when you go to retire in like 50 years, when you take the money out, it's tax-free, right? So that's a Roth IRA. A regular IRA is you take $1 today that you make pre-tax and you put it in the account, right? So in other words, you get to put the full dollar in. You don't have to pay taxes on it first before you put it in the account. But then in 50 years, when you take it out of the regular IRA, you have to pay tax on it again. All right, so the idea is imagine you're a student today and your tax rate is 0, right? You don't want to put everything into a Roth IRA because there's no difference between pre-tax and post-tax now because your tax rate is 0. And then when you retire and your tax rate's high, well, great, you don't have to pay taxes then. Right, but if you're in your prime income earning years, like let's say you're in the highest tax bracket in California, or you're making millions per year, then you want to use a regular IRA to pay, to do a pre-tax. You don't have to pay tax on it now, and then hope somehow you become poor or pay less tax when you get older. So that's the difference between the two.
Awesome. So we had a question, and I know it's probably on a lot of students' mind is, you graduate with a little bit of debt, right? You took out student loans and you can owe anywhere from, 50 to 500,000, depending on if you did bachelor, master, PhD. Like, how do you advise to invest if you have a large debt?
Sure. So that's a great question. So I know a lot of people have student loans. Just for the record, student loans are pretty much the best investment you can make. They're good debt, especially at a place like UCI that provides a lot of value, right? So we're public and it's more affordable. So my recommendation to people is if they have student debt, is take advantage of any company match first. All right. So a company match is like 100% free money. So even if you have student debt and you can't pay off your loans as fast as you want to, that match is worth more to you than paying off your student debt. All right. If you don't have, if you don't have credit, if you have credit card debt, you pay that off before your student debt. And the reason is because your credit card is charging like 25% interest, and your student debt's probably like 5% interest. But after that, I think the next priority should be paying down your student debt for a few reasons. The first is, of course, whenever you go to try and get a loan somewhere else, it counts against you, right? So if you try to get a mortgage or something else, they calculate how much your payment is on your student debt per month. And of course, that counts against you. And the second reason is student debt is actually really, really unique. And it's one of the few things that can't get discharged in bankruptcy. So if you go bankrupt, you can't pay your mortgage, you can't pay your car, and you declare bankruptcy. Even when you come out of bankruptcy, you still have that student debt to pay, unless it's incredibly crazy circumstances. So once you take your company match, once you paid off your credit cards, maybe you want to have a little bit of an emergency fund if you haven't set one of those up. Then I think student debt should be the next thing that you try to target.
Fantastic. So someone had a question about penny stocks, and are they a good investment? I mean, what do you do with penny stocks? Should you invest in them or should you not?
There's a reason they're penny stocks, right? It's because they suck. No offense. Penny stocks are back down to that gambling thing, right? I mean, there's, some of them will pay off, a lot of them won't pay off. And so, my advice would be probably if you stuck to regular investments, maybe you gamble on the right penny stock and you end up doing well. But if there's a higher probability you're going to still lose all of your money. All the famous movies that about Wall Street, like Wolf of Wall Street or Boiler Room, those are about companies who pitch penny stocks and everybody loses their money, right?
Definitely. And so we had a question about what's a good book for investing or a podcast. And I think that's a good time for you to plug your blog, I think.
Yeah, sure. So I do have a blog, boundedfinance.com. I do an update every couple of days on it. I do things on LinkedIn too. I had the blog because LinkedIn doesn't show you everybody that you're connected to, and it doesn't do it in order. So I don't make any money off the website or off the blog. I just do it for fun. I teach finance. I love finance. The center here, that Center for Investment Wealth Management, is all about financial literacy education. So I do it for that reason. In terms of good stuff to get started, that's a great question. I think probably the greatest book to get people started is something like a book called like The Random Walk on Wall Street. And it just tells you how hard it is to beat the market. I think it gives you the right kind of frame about how to think about things. I think if you're really interested in finance, Robert Shiller's got a great book called Irrational Exuberance, which is a great book to read. That's an easy read, even if you don't know much about finance. Otherwise, I think probably, I know that Dummies book isn't probably a great title anymore, but Investing 101 for, Investing for Dummies is also a great book that lays things out. So I think those are good places. Always Khan Academy has some good stuff too. But, I think that the important thing is I try to emphasize is, don't make investing hard. It doesn't have to be complicated. It doesn't have to be, someone who owns like 80 mutual funds instead of 2, like they're not going to beat you. They're just going to be different than you.
Great.
Here, I put the blog link in the chat for you.
Thank you. So then we
maybe
probably have time.
Questions, maybe two
more.
More?
Yeah, definitely. So this is a question from one of the users. What are annuities?
Sure. So annuities are a special kind of retirement asset, right? So an annuity is something that you put money in, and then an investment company guarantees you a certain amount of money for like 20 years. So you contribute money like $3,000 per year for the next 40 years. And then when you retire at 67, the company is going to give you $150,000 per year for 20 years, right? So this is called annuity. So basically that's called annuity because getting the same amount per year for a finite amount of time is called an annuity. So typically you have to be careful with annuities for 3 reasons. So one is annuities typically have really high fees, right? So they have high fees. So you want to avoid fees. That's the thing that really gets you in finance is when you pay pay a lot of fees, that's money that you're losing automatically, right? So they typically have high fees. Two, sometimes if you die when you're only like 5 years into the annuity, nobody gets the money. So you have to be careful that there's like your survivorship benefits to the annuity. And then the third thing is, remember, you have a company guaranteeing you the annuity. So just imagine you took an annuity with Lehman Brothers in 2005, right? And they go bankrupt, then you lose your annuity. So it's a contract with a company. It's not a contract with the government or somebody else. So be careful who you take the annuity with. I saw in the chat, I'll do one quick one and then I'll give you. So I'm going to ask if option trading is gambling. Yes, option trading is gambling. All right. So unless you have a really good reason to trade options, that's kind of gambling here. Go ahead.
Okay, so this will be a good one to end on. So people are wondering, when is the stock market going to crash? Can you predict it? Is it going to crash? Are we going to have another,
Sure.
1920s era crash?
Sure. So just remember, if we're doing the 1920s analogy, right, it's 1919 right now. So we have a solid decade before we crash, right? You remember the roaring 20s, the stock market, when the stock market was going up so much in the 1920s, we didn't need alcohol anymore, right? We had prohibition because people were so drunk off the stock market. And so, I think that's when is the stock market going to crash? I don't know. I mean, I'll just tell you my quick thoughts. So one is the stock market seems really expensive in some measures and seems really cheap in others, right? It really depends on what you look at. If you want to know more about the stock market, actually, I'll share it with the group here. I'm doing an econ finance update on June 10th. I'll talk more about this. But really, the stock market doesn't crash unless one of two things happens, and typically both. So one is earnings for companies is going down, and the Federal Reserve becomes very restrictive with monetary policy, which means they're raising interest rates. And right now, earnings is going way up because we're recovering from the pandemic, and the Federal Reserve promises they're not going to raise interest rates for like 2 years. And so typically, once they start raising interest rates, it's like 2 more years before the stock market crashes. So, we'll have some corrections. I mean, the market might go down 10, 15% at various points, but in terms of like the next 3 or 4 years, I can't see the market down like 60, 70% in the next few years. If anything, I think we're just going to keep going up. Or for the next few years. I mean, I would be careful owning things like ARK or other things that went up by a ton of money because there's only a limit to how far things can go up. So I know people got excited about FANG last year, Facebook, Apple, Amazon, Netflix, Google, because they were up like 62%. And I extrapolated for people that if they went up 62% for the next 6 years per year, that they'd be the entire stock market, right? Which is not going to happen, right? A company can only get so big. Like you're seeing it right now, this Epic versus Apple lawsuit. I don't know if anybody's following that. It looks like Apple's going to have to like let companies push, let people go pay for stuff other places, and Apple's going to lose the billions of dollars they make for free off the App Store. Right? There's only so big a company can get, and then at that point they'll get smaller. So, I don't think that there's going to be a huge stock market crash over the next couple of years. That's my guess.
So that means invest now. Thank you so much, Chris. We appreciate it.
Of course, I thank everybody there, and I thank everybody for the crypto comments. I know people are very religious. Actually, I started reading books about cults because I feel like some GMC, AMC, GME, crypto, some of these things, Tesla, are a little bit ARK. They're kind of like little cults. Certainly I'm an older guy now. I'm much older than most of the people on the call, and so maybe I don't understand things enough, but the most dangerous words, I'll just leave you this. The most dangerous words you can ever hear in investing is "this time it's different." And so if you hear someone tell you this time is different, that's the time to run for the exit. So that's a good time to go. So anyway, thank you guys so much for having me. Thanks for everybody tuning in, and thank you, Bryce, for having a great radio voice.
Thank you so much, and thank you to all of you who joined us today. The UCI Alumni has 3 to 4 virtual events every week. Check it out at alumni.uci.edu. The next big event for Young Alumni is a virtual mixer on June 30th, and we will be having our next adulting event in the fall, so be on the lookout for that. For those of you who have asked, we will provide the recording of this webinar in a thank you email, probably the next week or around then. And if you have any questions or comments, please email us at alumni@uci.edu. Thank you so much for joining us, and have a wonderful evening.